Let's take a broad look at what the markets are doing here. As you heard Scott mention, we've really given up the gains that we saw earlier in the session on the Dow, which is up 15 points at the moment. S&P is now negative by 2, NASDAQ by 12, even as bond yields have been falling. And oil is plummeting sharply today, with WTI crude dropping below $70, its lowest level since last June. Let's probe it all. We got new data raising hopes that inflation pressures are easing to pave the way for the Fed to start cutting next year. Productivity was strong. Third quarter non-farm productivity, 5.2%. That's up half a point from the last estimate, and it's the fastest pace in 3 years. Meanwhile, the private sector ADP jobs report showed an increase of just 103,000 jobs last month. Let's talk through the implications now with Greg Daco. He's chief economist at EY-Parthenon, and CNBC senior economics reporter Steve Liesman. Welcome to you both. Steve, I actually just want to kick this off with you because what Carson Block was just saying in terms of his bearishness about the economy, he's kind of implicit in his short position is that he doesn't think there's any way inflation falls to 3.5% without a significant economic slowdown next year.
Yeah, that's not been the right call. One of the extraordinary aspects of the decline in inflation that we've had has been amid relatively strong growth. I can't say he's wrong that it won't continue, but it has been a feature of the rebound in the supply chains, the increasing competition that's been out there, easing of wages. The data so far has been pretty good for inflation and not too bad for growth. There's an interesting question as to whether or not to follow the ADP number just at 103,000. I think the market might be a little bit surprised if the street consensus, which is closer to 200,000, ends up being right. But so far it has been, he's right over time that has been the case, but this time looks to be so far, Kelly, a little bit different. And where we're able to have stronger or relatively strong growth with inflation coming down.
Maybe I should restate it, actually, because what he said is he doesn't think the Fed will cut rates. You know, that the overnight Fed funds rate, or SOFR, what is the metric he uses, goes to 3.5%. They won't really be doing that unless there's a material slowdown.
It is a race right now, and I was really interested in that interview. I don't think he's wrong that there are going to be a lot of companies that are going to have a lot of trouble when it comes time to refi. Whether or not that stacks up to a recession is a different question, and can it be isolated to just those particular industries that are having problems? I think the Fed cutting is going to absolutely happen if inflation continues to fall. And I'm guided by comments by Fed Governor Chris Waller, who just said, hey, of course we're going to do that. Because we're not going to be tighter than we need to be. So the Fed will come down if inflation keeps coming down, or at least even maintains current levels by this time, say, in the summer or the spring of next year.
Greg, what would you add to that, and what did we learn this morning from the data?
Well, I think we are seeing a soft landing in terms of economic data. I think Steve is absolutely on point when it comes to the dynamics that have been very encouraging. We've seen inflation come down quite significantly. We haven't seen the type of economic pain that the Fed itself was warning us about in this environment. The key question for 24 is really whether the runway is long enough to sustain that soft landing, or whether we enter an environment where there is much softer growth. With regards to the Fed, I do think the Fed is going to pivot. It's not going to announce it at the December FOMC meeting, but it will likely quickly pivot towards how to recalibrate monetary policy for next year. And that recalibration in communications likely to occur in the early part of next year.